Trish is, of course, here with me. Trish, currency markets off to a firm footing this morning, yeah?
Well, it's already, it started off on a firm footing, house, but it's already like paring a lot of its gains. We see that the Australian and the Kiwi dollar are already slightly lower at the moment. The Kospi actually turned around, and is down about, it kind of erased its loss, its gains. And the Taiwan TAIEX is actually weaker as well. So we're seeing quite a bit of paring back, and the risk aversion is coming back into play again. Traders are telling me that, the China market, China's stock market is going to be the key driver, at least for the next 12 to 18 hours anyway, until we get stronger numbers, more important numbers from Taiwan and Philippines later today, and the US as well in tonight. But for now, it's really going to be all about stocks.
All right, Trish, stay put. Let's get to our Forex guest this morning, Philip Wee, senior currency economist at DBS. He joins us here in the Singapore studio. I mean, Trish was saying that risk aversion is back.
I would tend to agree with her, because ever since August 4th, when China's stocks peaked, currency markets have been struggling in about 200-300 point ranges. So I think generally, the market basically needs a stable U.S., a growing China, for them to take risks. But China, I think, since the start of this month, has indicated that government-backed projects will probably be fewer than what you saw in the first half, and that the robust lending, the numbers are already showing some signs of slowing down. So I think markets generally taking profits on this risk, that they've taken on since March.
Philip, Trish here. Now you actually called for the dollar to actually strengthen to as high as 1.3 to the euro in the coming days, and then you actually based it on the fact of the trade deficit. Whereas we have of the narrowing trade deficit. On the other hand, we have PIMCO same day as well yesterday, who actually expects that the weak dollar will actually weaken considerably, simply because the U.S. is pumping so much liquidity into the system, and the dollar is increasingly losing its global reserve status, and markets concerned about that. What can you explain a bit more on that?
I think generally, when we look through the dollar, we really gave a lot of thought to it. And I think if you look in terms of the balance of payments, U.S. has improved. The Europeans and the Japanese, the trade balances have deteriorated. And the RER in the dollar is actually the weakest compared to the euro and the yen, which are really very strong, vis-a-vis the fundamentals. So here we find a misalignment, and we feel that if the G3 ever decides they want to intervene in any currency, it would be to support the US dollar. As far as I think markets are concerned, since March, they have sort of been locked into this risk aversion, risk-taking mode, where they basically, whenever they buy equities, they would like to sell the US dollars. And part of it is also due to the pre-crisis era when markets were rallying and the dollar was weak, commodities were moving up. So, but they tend to forget that before the crisis, one of the major drivers of that was really the Chinese yuan being freed against the dollar, and it was accelerating its appreciation because of inflation concerns. But today, if you look at the Chinese yuan, in fact, I would say that since the start of this quarter, the trading range for dollar China has narrowed to 0.1%. compared to 0.4% in the first half of this year and 1% in the second half of last year. So I think more or less, I think market needs to also realize that the dollar selling or the dollar losing its safe haven that we've seen from March to June, the conditions that were in place are very different today. Okay, I will give two examples. I'll give one example. One is the debt monetization. In March, the U.S. had just signed the fiscal stimulus package in February. The Fed agreed to debt purchases. Okay, the last FOMC, the Fed has indicated that the debt purchase program for treasuries will probably end in October. And the fiscal, and yesterday we've seen the U.S. projecting a smaller fiscal deficit for this fiscal year.
But I don't understand, why shouldn't the dollar be threatened by all the rescue money that's flooding the market? I mean, Warren Buffett calls it the so-called monetary medicine.
I think the thing is that, you see, I never like the argument that central bank print money and therefore the currency should be weaker. If you look at actual data, for example, let's take Japan, for example. Japan quantitative easing started from 2001. It ended in 2006. But from 2002 to 2004, dollar-yen was falling. So... And the other thing is that when you look at the ratio between European money supply and U.S. money supply, when the euro was weakening since 2002, European money supply was really increasing faster than the U.S. So this is where we decided that maybe we got to be a bit careful with generalizations here.
Okay, Phil, we'll leave it there for the moment. We'll be back with Philip Wee, senior currency economist at DBS, right after the break. We're off for a short break. More with Philip Wee and his currency picks when we come back. Stay with us. Now, let's rejoin our Forex guests. That's, of course, Philip Wee, senior currency economist at DBS. We've been talking about the dollar. And we have a question here from a viewer who wants to know, what will it take for the dollar to recover to levels of 84, 86 to the euro?
Well, I guess it would take a lot.
But that said, reversal.
Yeah, but that said, we are looking for 130, a pullback to 130 by in the next few months. This is based very much on the fact that we take a view that currencies actually consolidate in a range after a crisis, and we think that the dollar has already fallen from the top of the range to the bottom of the range. So we are really calling for sort of correction and a retracement within the range.
But for 84, 86, what would it take for what? For the European economies to stumble altogether?
I think the last time we've seen that level, that was in 2000. Interestingly, during that period, the current account deficit was also very wide in Europe. In fact, today it's wider, but the euro is at the opposite side of the spectrum. It is too strong rather than too weak. Okay, but the reason for that is because of the global crisis, that the U.S. brought the world into. Okay, so, but that said, I think for the euro to sustain a trend down back towards that, we really need U.S. proving to the world that he's not Japan. And U.S. can return to a rate hike cycle, and rate hike cycles tends to be very deadly for carry trades, because effectively it's removing dollar supply from the system. And I think last year, the world in the post-Lehman days discovered, how deadly that could be.
Hey, curious, what are your favorite currency picks?
At this moment, I guess the question is, who do I think will correct most if the dollar starts moving up? We are looking, based on our studies, the cycles are showing us that we should be more alert next month, September, maybe as we near the end of the Japanese fiscal year end. So I would basically like to unwind the currencies that have done very well. The Australian dollar is the one that concerns me the most because the rally from the bottom is unprecedented. And the other thing is that if you look through all the bottoms, the Aussie rise from the bottom, all the years that I've seen, based on today's prices, it shouldn't be up here above 80. It should be closer to 68 to 72 range. So that's pretty far away.
How about the yen? Is it losing its appeal given the political situation there?
The yen, I think there's too many things driving it. Funding currency, safe haven. But based on the studies of dollar yen that we've seen, the cycles, technically it should be thinking about making an up move back towards 100 level in the late fourth quarter into the first quarter. We may see levels as high as 105 by the first quarter next year.
All right, Philip, we're going to leave it there. Philip Wee of DBS joining us here in Singapore.